Something very unusual is happening in the gold market right now, and almost no one is talking about it. With only a few days left before the February gold contract must be fully delivered, there are still thousands of open contracts standing for physical delivery. We are not talking about small numbers. We are talking about 4,366 contracts. That equals 436,600 ounces of gold, around 13.5 tons. And for this late in the delivery cycle, that number is extremely abnormal. In fact, it is many times higher than what is normally seen at this stage. Welcome to Gold Silver Scope, where we break down what really matters in the gold and silver markets in simple and clear language. Let's first understand why this situation is raising serious red flags. In the futures market, most traders never take physical delivery. They either close their contracts before expiry or roll them into the next month. That is how the system usually works. But when contracts remain open very late into the delivery month, it means someone is demanding real metal, not paper settlement. Now here is the concern. Liquidity becomes very thin toward the end of a contract cycle. Most traders have already shifted to the next active month. So if someone is still heavily short, meaning they sold gold contracts, and they do not actually have the physical gold to deliver, they can get trapped. And if they cannot find enough metal in time, the situation can turn serious very quickly. Gold is a market built on confidence. As long as participants believe there is enough metal to meet delivery obligations, the leverage in the system remains stable. But the moment doubt enters the market, the moment people start asking, is there really enough gold? That leverage can unwind violently, and this is why the remaining 13.5 tons matter. If this gold is delivered smoothly, the market moves on. But if there are delays, stress, or visible difficulty sourcing metal, confidence can weaken fast. When confidence breaks, price reactions can be sharp and sudden. Now think about this carefully. If someone sold gold without having it, expecting to buy it back later at a lower price, and instead physical demand tightened, that seller is now in trouble. They must either find real metal or close their position at higher prices. And with thin liquidity, closing large positions becomes expensive. This is how short squeezes begin. We also need to understand something important. Physical gold supply right now is not loose. Vault stocks are tight compared to past years. Central banks around the world have been accumulating gold aggressively. Long-term holders are not eager to sell. That reduces available supply in the system. So when unusually high delivery demands remain open late into the contract cycle, it becomes a warning sign. Now let's step back and look at the bigger picture. This is not just about 1 month. This is about the structure of the market itself. Futures contracts create leverage. A small amount of physical gold supports a much larger amount of paper claims. That system works smoothly only when very few people demand actual delivery. But if more participants begin asking for metal instead of cash settlement, the pressure builds. And that brings us to silver, which in many ways is even more explosive. Silver is the tighter market. Silver has a smaller above-ground stock compared to gold relative to its paper market size. Silver contracts represent 5,000 ounces each. And recently, the activity in silver has shown even more unusual behavior. Before we move fully into silver, understand this. Gold is the foundation. If stress begins there, it sends a signal. But silver reacts faster and often more violently because its market is thinner. In gold, we are watching 13.5 tons with only days remaining. That alone is abnormal. But what is happening in silver may be even more shocking. Now let's move to silver, because this is where things become even more interesting. In the February silver contract, about 23 million ounces have already stood for delivery. That means contract holders did not choose cash settlement, they asked for real metal. Normally, that would already be a strong number. But here is where the situation becomes unusual. During the same period, over 38 million ounces of silver have actually left the vault system. Think about that carefully. 23 million ounces were officially delivered through contracts, yet more than 38 million ounces physically left the warehouses. That means silver is being withdrawn at a much faster pace than it is being delivered through futures contracts. That raises a very serious question. Who is taking that metal? To understand this, we need to explain the two main vault categories in the exchange system: eligible and registered. Registered silver is the metal that is available to back futures contracts. It is ready to be delivered against open contracts. Eligible silver, on the other hand, belongs to private owners. It is stored inside approved vaults, but it is not automatically for sale. When someone stands for delivery, metal can move from registered to eligible status. That does not mean it leaves the vault. It simply changes ownership. But when silver is physically withdrawn from the vault system entirely, that is different. That means trucks are moving real bars out of the warehouse. And 38 million ounces leaving is not a small number. To put it in perspective, a standard 1,000-ounce silver bar weighs around 70 pounds. Multiply that by tens of thousands of bars. The logistics alone are massive. This is not retail investors buying coins. This is institutional-scale movement. So again, we ask, who is accumulating this much silver? This pattern has been happening for many months. It is not a one-time event. Month after month, large quantities of silver are being delivered and then removed from the exchange system. When metal leaves, it often does not return quickly. It moves into private vaults, sovereign storage, or long-term holdings. And here is why this matters. Silver is already a tight market. Industrial demand is strong due to solar panels, electronics, electric vehicles, and other technologies. At the same time, investment demand has increased as people look for protection against inflation and currency risk. If large players are quietly removing metal from the exchange system, available supply becomes tighter. Now consider how futures markets operate. The price you see every day is largely determined in the paper market, not in the physical market. Futures contracts trade in large volumes compared to the actual metal available. As long as physical demand stays moderate, this system works fine. But if physical demand keeps rising and metal continues leaving vaults faster than new supply enters, the balance begins to shift. The paper market can suppress price perception for a long time by creating the image of abundance. But physical withdrawals tell the real story. And here is something even more important. Some observers believe that state-level actors, meaning governments, sovereign funds, or entities connected to national financial strategies, may be involved in these large-scale accumulations. Why would they do that? Because precious metals are monetary assets. Gold and silver are not just commodities. They are stores of value outside the traditional banking system. In times of financial uncertainty, currency instability, or geopolitical tension, physical metal becomes strategic. When countries want to strengthen their financial position, they accumulate real assets quietly. They do not announce large purchases publicly because that would drive prices higher immediately. Instead, accumulation happens slowly, steadily, and often through intermediaries. In the Global South, coordination between nations has increased. Many countries are reducing dependence on the US dollar system. They are diversifying reserves. Gold accumulation by central banks has already been visible in official data. Silver, although less discussed at the central bank level, plays a critical industrial and strategic role. If silver becomes classified as critical for national security and industry, governments may treat it differently. And when governments decide something is critical, they can restrict exports, build strategic stockpiles, or support domestic accumulation. We are not saying this is confirmed. But the pattern of consistent withdrawals, combined with geopolitical shifts, suggests that something bigger may be unfolding. The key point is this: If physical metal keeps leaving the exchange system faster than it is being replenished, pressure builds quietly beneath the surface. Most mainstream coverage focuses only on daily price moves, but price does not always reflect structural stress immediately. Sometimes stress builds for months before it becomes visible in price action, and silver, because of its smaller market size, can react much faster than gold once confidence shifts. If participants begin doubting whether enough registered metal exists to meet delivery demands, the reaction can be sharp. This is why watching vault data and delivery numbers is more important than watching headlines. And right now, the data is telling us that physical silver demand remains very strong. Now let's step back and connect all the dots. In gold, we are seeing unusually high open contracts very late in the delivery cycle. In silver, we are seeing physical metal leaving vaults faster than contract deliveries alone would explain. Both of these signals point to one thing: growing stress between paper markets and physical reality. For decades, the futures market has shaped price perception. Large volumes of paper contracts trade daily, often representing many times more metal than actually exists in deliverable form. As long as most participants settle in cash or roll forward, the system functions smoothly. But when more players demand physical delivery, that balance shifts. Gold and silver markets operate on confidence. The confidence that metal will be there if someone asks for it. The confidence that registered stocks are sufficient. The confidence that liquidity will remain deep enough for shorts to close positions easily. If that confidence weakens, leverage unwinds, and leverage unwinding in precious metals can move very fast. Now think about the bigger macro picture. Around the world, countries are reassessing financial systems. Inflation has reduced purchasing power. Debt levels are historically high. Geopolitical tensions are elevated. Trade relationships are shifting. Some nations are building alternative payment systems and increasing reserve diversification. In this environment, physical gold makes sense for long-term monetary security. And silver, because of its dual role as both monetary and industrial metal, becomes even more strategically important. If sovereign entities, large funds, or long-term strategic buyers are quietly accumulating metal, they will not announce it loudly. They will use multiple channels. They will spread purchases over time. They will avoid drawing attention. And by the time the broader public fully understands what happened, the price may already have adjusted significantly. This is why monitoring delivery data and vault withdrawals matters so much. When 38 million ounces of silver leave exchange vaults in a short period, that is not normal retail behavior. That is large-scale positioning. When 13.5 tons of gold remain open for delivery days before expiry, that is not routine activity. These are stress indicators. Does that guarantee an immediate price explosion? No. Markets can stay stable longer than expected. Systems can adjust, shorts can source metal, contracts can be settled. But the risk profile changes when physical tightness increases. If physical demand keeps absorbing available supply, eventually the paper market must reflect that reality. And when it does, price adjustments are rarely slow and gentle. They tend to be sharp and fast. That is why preparation matters. Preparation does not mean panic. It means understanding the difference between owning paper exposure and owning physical metal. It means recognizing that leverage works both ways. And it means staying informed instead of reacting emotionally. In uncertain financial times, tangible assets with no counterparty risk become more valuable. Physical gold and silver have served that role for thousands of years, long before modern financial engineering existed. If the current patterns continue, we may be watching the early stages of a structural shift in how precious metals are valued globally. The next few delivery cycles will be very important. Watch whether vault withdrawals continue at elevated levels. Watch whether open interest remains unusually high into expiry. Watch whether governments introduce new classifications or policies around critical minerals. Those signals will tell the story. If you want clear, simple breakdowns of what is happening in the gold and silver markets without hype or distractions, make sure you follow Gold Silver Soccer's scope. This channel is focused on helping you understand the structure behind the price, not just the daily headlines. Stay informed, stay prepared, and always think long-term.